Welcome back to Stock Trader School, from Rookie to Rainmaker, and this is Tactical Tuesdays. We look into strategies that exist on the opposite ends of a spectrum. Both are lightning quick, yet each has its own unique way of looking at the market. The definition is to skin or scrape something, usually referring to making small cuts or removing a thin layer. This tactic is all about taking small profits quickly. But it's not just about speed. To do this successfully, you must embrace high volume. Being a scalper is an adrenaline-fueled experience. It's like a game of high-speed chess where every move counts and every second matters. It's a high-stakes world where fortunes are made and lost in the blink of an eye. If this sounds exciting to you, then congratulations. Think bigger lots, potentially up to 5 mini, and even higher. Your stop loss can also be more substantial, ranging from 25 pips to 50 pips, depending on your comfort level. Take profit targets can vary, but typically range between 30 and 60 pips. If you have the patience and discipline to master this skill, then you too can become a deadly sniper in the financial markets. Here we want to talk about 3 key components: timeframes, order flow, and confirmation signals. These 3 elements combined provide a powerful toolkit that allows you to navigate the complexities of the financial markets. Remember, the sniper is all about quality over quantity. Scalpers often look at the 1-minute or 5-minute time frame, whereas snipers prefer the 15-minute and 30-minute time frame. On the other hand, if you prefer a more measured approach and enjoy the challenge of reading the market, then sniping could be your calling. Remember, there's no right or wrong way to trade. The most important thing is that you find a style that suits you and that you're comfortable with. Order flow is another important tool in your arsenal. By understanding order flow, you can anticipate where large institutions are buying and selling. This information can be invaluable, especially when it comes to generating sniper entries. Lastly, confirmation signals are a great way to improve the odds in your favor. These are signals that confirm your suspicion about the direction of the market. For example, if you're a scalper looking at the 1-minute time frame, you could use the RSI or MACD as a confirmation signal. Whereas if you're a sniper looking at the 15-minute time frame, you could use the Fibonacci retracement tool as a confirmation signal. You might just have what it takes to be a successful scalper. That's because the higher the volume, the more likely it is that price will move in your favor, resulting in multiple winning trades in a single session. This is a style of trading that requires patience, discipline, and a keen eye for detail. Unlike scalping, which involves making numerous trades in a short period, sniping is all about waiting for the perfect opportunity to strike. Instead, focus on the 15-minute and the 30-minute charts. These timeframes offer a better balance between speed and accuracy, allowing you to capture larger movements while minimizing the impact of random noise. A sniper is a master of disguise, patiently lying in wait, observing their target, and selecting the precise moment to make their move. Well, the first step is to identify a clear uptrend or downtrend. Once you have, you would then mark your level of interest by drawing a trend line across the highs of the most recent candles. Next, you would then wait for price to break this trend line before entering the trade. Once you get in, you would use a 1-to-2 risk-to-reward ratio, and sometimes even a 1-to-3 if the market is strong enough. And here's an example of what this could look like on the 15-minute chart. First, we identified an uptrend and drew a trend line across the recent highs. Then we waited for a break of this trend line before getting in. Using a 1-to-2 risk-to-reward ratio, we were able to exit the trade at a healthy profit. They strike with speed and accuracy, causing maximum damage with minimum effort. Of course, this also means that there's an equal chance of losing multiple trades in a row. So being comfortable with fast risk is crucial to your success. Both can be highly profitable, yet each caters to a different personality type. And in terms of your stop loss, this should be no more than 15 pips. As for take profit, this is going to depend on the momentum of the market. If it's trending strongly, then you can afford to be a bit more aggressive. However, if there's a lack of momentum, then you need to dial down your targets to as little as 5 pips. And when it comes to the time frame that you should use, this is very much dependent on the market conditions. During trending markets, you can look at shorter time frames, such as the 1-minute and the 5-minute, to help initiate your entries. However, During sideways markets, you may want to switch to longer time frames, such as the 15-minute or the 30-minute, to help increase your probability of a winning trade. So which will you choose? Will you attack like a scalper or strike from afar like a sniper? Let's get into it. Well, the best way to do this is to find areas of value, whether it'd be swing lows, trend lines, or structure from the previous candles. You would then simply wait for price to reach these levels, and once it does, you would execute your trade. It's really that simple. Here's an example of what this could look like on the 1-minute chart. First, we marked our level of interest by drawing a trend line across a swing low. Then we patiently waited for price to return to this level before entering the trade. Once we got in, we used a 1-to-2 risk to reward ratio for our take profit, which gave us a total of 10 pips. First up, let's examine what it means to scalp. In terms of position sizing, this is a method where you want to keep your lot sizes small, no more than 1 mini, and oftentimes less than 0.01. So how exactly would you enter a trade using this strategy? If you're someone who enjoys fast-paced action and likes to be in and out of the markets within minutes, then this may be the style of trading for you. But now let's turn our attention to the other end of the spectrum, the sniper. When it comes to position sizing, this is where you want to be more aggressive. As for the time frame that you should use, here you want to stay away from the 1-minute and the 5-minute charts. So how exactly would you enter a trade using this strategy? Being a sniper is a lonely existence. It's a solitary pursuit that requires a great deal of mental fortitude and emotional control, but the rewards can be great. Now that we've looked at both strategies, let's discuss the tools that you can use to implement them. When it comes to time frames, remember that both scalpers and snipers rely on different time frames to generate their entries. By combining these three tools in a strategic way, you can make informed decisions about when to buy and sell. Pick your strategy, play it sharp. You're only as good as your precision. Catch you next Tactical Tuesday.